Most often people are perplexed and have the thought that if their government could just print a lot more banknotes, then everyone would have enough money and no one would be poor and everybody gets to live happily ever after. Right? But why though? Why is it that the government can't just print a lot more money because it makes more sense? Are they evil and want people to keep being poor? Well, the answer is you've probably had it shoved down your throat countless times. If you research this kind of stuff, then you would know it is inflation. Inflation explains it all, and it is the shortest answer to this whole conundrum, or is it? For the longer, more detailed, and as always slightly controversial version of the answer, all you need to do is take a sec to hit that like button so that we can get on our way. Have you done that? Great. So, where were we? We were talking about nations printing more money to pay off their debts or sharing so that none of their citizens is poor. Well, we all know that African countries owe huge sums of money, especially to China. We even have a video on our channel of the African with the most Chinese debt. That aside, does Africa need to continuously borrow money for her today's survival while creating debt burden for the next generations? Well, according to standard economic theory, printing money exposes a government to inflation since there will be more money in the economy to chase fewer products, causing the money to lose its value. Do you know of the $100 trillion Zimbabwean bills? That's a good example of what we're talking about here. However, if we can think beyond these theories and accept that they were developed for humans, people like us who also have the capacity to devise alternative models to solve our own problems, we can begin to ask questions like, how can there be fewer goods in the system if the money printed is used as an incentive for innovation and production, rather than as a demanding object for goods and services? What are the key distinctions between money printed in an economy and money borrowed in the same economy? When a government borrows money, it demonstrates to a considerable extent that it lacks the skills and understanding to run the economy effectively. Unfortunately, since gaining independence, the idea of borrowing paper, in other words, fiat money from another sovereign country, rather than using our sovereign status to print money and manage this printed money to support our developmental projects and programs, has become a normal and easy way for almost all African countries. Why should someone print paper and hand it over to you as money and expect you to pay back with the same paper, but not with paper that you have the right to print? In this case, if America prints dollars for us to support our economy, we should be able to print our own currencies to pay back once our economy has grown stronger, not with the dollar that we do not have the right to print. If we can pay back with our own currency, which we have the right to print, then our currency has a value for us. Instead, we are required to pay back with paper that we do not have the right to print. Was that too much for you to grasp? Now, look at this. Basically, the dollar serves as the reserve currency for the entire world. So, when countries obtain loans from, say, the IMF or the World Bank, they are loaning that money in dollars. Now, when we collect the dollars or American papers, we can't use it in our economy as dollars. What we do is, we print our own money backed by that dollar. But the thing is, America prints trillions of dollar bills yearly, and they aren't backed by anything other than the idea that the dollar is worth something. Now the problem is when we've invested the loaned money in our economy, and the economy has grown, we can't pay back our loan in our currency, which we have the right to print. We have to pay back the loan plus interests in dollars that we can't print, so we have to purchase more dollars by trading stocks. If we paid back the loan plus interest in our own currency, we could just print it and send it over for them to decide to hold against the dollar, in other words, the value of their currency. The dollar will be backed by ours. However, the IMF and World Bank refuse this as it will not benefit them as much. Before proceeding, it is necessary to note that under extreme circumstances, a country may borrow money in one or two cases, as was the case in continental Europe after World War II. America was forced to create and loan money to Europe under the Marshall Plan to help them recover from total collapse. However, borrowing paper money as a means of survival is extremely unusual for a sovereign nation. No one has ever been able to borrow their way to freedom or growth. At this stage, let us note, firstly, that every sovereign state, no matter how small it may be, has the right and authority to print and manage its own money. Secondly, we explain unequivocally that printing money does not cause inflation, and that the concept is, at the very least, a lie. Inflation and deflation are caused by the manner in which printed money is managed. For example, suppose the government of Ghana, or any other African country of your choosing, recognizes that a region or state requires a road and estimates the cost of constructing the road to be 50 billion Ghana cedis, or the currency of your selected African country. So, if the government prints 50 billion Ghana cedis for this project and then hires a Chinese or European construction company to build it on the condition that the government or the ruling political party receives 20% of the capital cost as a kickback, the following will happen. Payment must be made in Chinese yuan or European euro, according to the Chinese or European firm. This means that the Ghanaian government must sell the local money it has printed on the international financial market in exchange for yuan or euros. When this occurs, there will be more cedi on the market than there should be, and if there are not similarly many clients on the market seeking cedi, the value or relevance of cedi will be reduced, resulting in a severe or continual depreciation of the cedi's exchange rate. Once the firm pays the government or political party in power 20% of the capital cost, it is free of any system of control intended to oversee and manage the economies of the African country. In this situation, the foreign construction company will build a road of poor quality that falls far short of what the money it has received should ordinarily build. It will underpay local labor if it ever hires any, and it will evade all taxes and other statutory payments. The combination of these bad measures will damage the country's economic management regime. It's also worth remembering that the 20% that has ended up in the hands of the ruling gangs is merely paper, as they acquired it without working or trading any value for it. This has the same effect on the economy as when a criminal sits in his or her room and prints counterfeits before releasing them into the economy. However, this money will be cheerfully released into our economy through unproductive and abusive channels, such as paying for sponsoring political hooliganisms to destroy lives and property in our countries, and taking expensive vacations abroad and flaunting at public gatherings and events. In the end, Ghana will have utilized its sovereign authority to print 50 billion in currency or paper, but that 50 billion paper will not have been adequately managed to transfer into or create genuine wealth in the equivalent of 50 billion. Because the objective of the money generated was to serve as an object for demand rather than an incentive to stimulate production and innovation, this, among many other negative economic outcomes, will result in inflation, with more money in the system chasing fewer commodities. Because no one can trust a system managed by ineffectual heads, it will also result in exchange rate depreciation and damage to the country's economic sovereign worth. On the other hand, if the government prints 50 billion worth of local currency for the purpose of building a road and ensures that local construction companies' capacity to complete the project is strengthened, the government will not need to put such a large amount of local currency up for foreign exchange. This is because local companies are paid in local currency, causing the local currency's exchange rate value to be harmed. Ethiopia has been able to create a strong local construction, banking, and telecommunications sector in order to promote the country's internal development. Ethiopia's system can be used by other African countries. In the event that 50 billion is printed to embark on road construction, all that the governments have to do to avoid inflation is to internally manage this printed money to ensure that it is fairly and widely distributed, and it translates into multiples of actual values and wealth in the economy. So, why is fair and widely distribution of printed money important? Firstly, every member of a community possesses some potential or value that, if nurtured and developed, will contribute to national growth. This value, however, cannot be tapped unless reward and recognition regimes are established as a mode of trade for citizens' intrinsic values. Following the printing of money, the government has a management responsibility to ensure that the money does not become concentrated in the hands of a few individuals. Rather, it should be wisely and widely distributed with the goal of using it as a bait to attract and uncover the hidden potential in citizens for national development. While company owners' primary goals will be to maximize profit, the government, which has a responsibility to deliver social good, must always strive for quality and guarantee that standards are properly followed. Contractors are then expected to spend the money received equally throughout all sectors of the economy, ensuring that the money is distributed widely and fairly. The construction of a single road, for example, can result in increased demand for general logistics, available capital for trading and banking operations, increased employment and welfare for citizens, and capital returns for the government to embark on other projects generated through an efficient and transparent tax system, and many other economic benefits. When printed money is efficiently managed to inject the above benefits into the economy, the beneficiaries will use and reuse the money or benefits to produce multiples of values far greater than the initial value of 50 billion, promoting the steady and long-term development of the country. So, will printing money rather than borrowing be an easy thing to do in any African country? Certainly not. In fact, no single African country will find it easy to implement this strategy. This is because lending to keep Africa and her future in debt is a big business that aids those who want to keep Africans in a state of perpetual slavery by controlling both labor and human capital, as well as natural resources on the continent. Any country or leader that undertakes such an attempt will be subjected to sabotage, sanctions, and likely power instability from the system's masters. Nonetheless, Africa will undoubtedly triumph if all or the majority of African countries band together and make this a continental policy. We must evaluate if we are ready to bring our next generation into a new paradigm of servitude if we do not do so in unison. Make sure to watch our video for the African countries with the most Chinese debt. You can find the link in the description below. If you enjoyed this figure, hope you've left a like. Also hit subscribe so you can be part of our community of touristers here on the New Tourist channel. Thanks for watching and see you in our next video.